And to further explore the issue of climate scenario analysis and stress testing, we will have a panel now to talk about that. And I want to introduce the members of the panel, three world-class experts. Kevin Stiroh, who's Senior Advisor at the Federal Reserve and Chair of the Fed's Supervision Climate Committee. Fabio Natalucci, who's Deputy Director of the Monetary and Capital Markets Department at the International Monetary Fund. And Alex Brazier, former Executive Director for Financial Stability, Strategy and Risk at the Bank of England. Now, I think the people on this panel at least suspect that climate risk is investment risk and could be financial stability risk. But we also all recognize that there are challenges to using scenarios or stress tests, two tools to assess those risks. And we heard about the challenges from disclosure earlier. There are fundamental differences between macro and financial shocks and those related to climate change, either from physical risk or especially from transition risk. And we don't have adequate data or understand the relationships well enough. But it's pretty clear that we have to get going and start on this. So the first essential step is to design the scenario analysis to assess risks and vulnerabilities. And hopefully that will get banks or other firms to disclose risks and just generate data to indicate where those vulnerabilities might be. And we'll learn from that process what constitutes resilience and where there are vulnerabilities. So let me start with Kevin. Kevin, can you please tell us how you think about the distinction between scenario analysis and stress testing, and to help us define the topic in terms of its purpose, scope, and other criteria and what we hope to learn? And can you discuss those in the context of your work chairing the Basel Committee's Task Force on Climate-Related Risks and in the new Supervision Climate Committee? And perhaps even indicate what role climate scenario analysis might play in supervision.
Great. Thanks, Dick. Can you hear me okay?
Yes.
Great. Well, thanks again for the opportunity to participate in today's event. I think it's really productive to bring together such a range of views from the industry, from the official sector and academia to discuss these topics. The financial risks of climate change is extraordinarily complex, and I think we'll all develop a deeper and more robust understanding when we bring together this diverse range of views. So it's clear that the financial risks of climate change is becoming a greater topic within the financial sector. We see large institutions working to better understand, measure, and ultimately manage these risks, and also to assess the opportunities from a business perspective. Prudential supervisors around the world are developing frameworks, tools, and methodologies to assess these risks for individual banks and also for the financial system as a whole. And as you pointed out, one tool that's gaining particular traction is the use of climate scenario analysis. The Basel Committee's Task Force on Climate-Related Financial Risks, which I co-chair with Frank Elderson of the ECB, recently reported that 17 out of 19 member jurisdictions surveyed indicated the use or planned use of scenario analysis or stress testing to measure these risks. And perhaps even more prominently, several global supervisors are currently conducting these types of assessments, and others have signaled their intention. And I expect we'll hear more about this from Alex. The focus on scenario analysis is not surprising, given the inherently forward-looking nature of climate-related risks. So recently, the Basel Committee published an assessment analytical report on measurement methodologies that are currently being used by the private sector and by supervisors around the world. And I'll focus my remarks today on results from that report. And I won't get into views or plans for any specific jurisdiction, including the US. So the task force work began with a very traditional risk management perspective that included risk identification, exposure mapping, risk quantification, and risk management. Now, this is a familiar framework, but the financial risks of climate change bring distinct challenges related to data granularity, heterogeneous impacts, different types of amplifiers and mitigants, and the need for a forward-looking assessment. And this last point about forward-looking models is particularly important because the types of physical and transition risks associated with the changing climate are unprecedented. Trusted models based on historical data may prove to be a poor guide for future outcomes. And that's where scenario analysis comes in. Climate scenario analysis allows firms and supervisors to better understand how climate risk drivers may impact financial outcomes and to consider how the financial sector may respond to these risks. These climate scenarios are typically exploratory in nature. They can help facilitate an assessment of business model resilience to a range of climate risk scenarios. And they can help identify exposures that are potentially vulnerable to these risks. The Basel Task Force report describes a general framework in 4 steps. First, to identify the physical and transition risk scenarios. Second, to link the impacts of climate scenarios to financial risks. Third, to assess counterparty, sector, and collateral sensitivities to those risks. And finally, to extrapolate the impacts of those sensitivities to estimate an aggregate impact on the firm. With that description in mind, I do think there's an important distinction to make between climate scenario analysis and traditional regulatory stress testing. Generally speaking, as currently practiced by international supervisors, scenario analysis is typically a longer run, more qualitative exercise to understand the potential impact, to shine light on emerging risks, and to assess business model resilience across a range of potential outcomes. It promotes critical thinking and facilitates an informed discussion across scenarios. By contrast, stress testing is typically a shorter run, more quantitatively precise exercise designed to assess capital adequacy and the strength of a firm's internal capital assessment process. There are differences and exceptions, of course, but I think this is a useful heuristic, and it shows fundamental distinctions in objectives and how these tools are ultimately going to be used. As discussed by Governor Brainerd in a speech earlier this year, scenario analysis and stress tests are best seen as complements rather than substitutes or synonyms. And the relative usefulness of each approach will depend on the specific question that's being asked and the specific steps that might be taken afterwards. So to wrap up, scenario analysis is clearly emerging as an important tool for the assessment of climate-related financial risks, although we are in early days of the development of these tools. I think further collaboration with the public sector, with the financial industry, and the academic community will be needed to address both the conceptual challenges related to things like fundamental uncertainty and deep complexity, and the practical challenges related to data, model development, and execution. So thanks for your attention and look forward to a productive discussion.
Thanks, Kevin. So Fabio, we've just heard a discussion earlier about data and disclosure, and you've told us that the IMF is also working on the framework for disclosure. Can you talk to us about that a little bit? And in particular, perhaps how the climate change indicators dashboard that you've just produced might inform your thinking. Will those data figure into assessments of financial stability or growth at risk analysis? How do you think about harmonizing the differences across borders? And could they eventually figure into the financial sector assessment programs? You're muted.
There you go, sorry. There's a lot of questions there. So let me maybe bucket them in 3 blocks, right? One, how we think about data and disclosure, both at the fund where I work, as well as on my putting my hat on the NGFS, the Network for Greening the Financial System, co-chair of the work stream on bridging the data gap. How we think about this in terms of the Global Financial Stability Report and how it could fit into growth to risk, and then finally a few words on the FSAP, how it could eventually feature there. In terms of data, whether we think about financial stability issues, fostering sustainable finance markets, whether this is about pricing efficiently climate risk, there are a number of challenges, right? So Kevin touched upon some of them, from model uncertainty, to uncertainty about policy response, consumer approach to this, and informational challenge. So I'm going to focus on the informational challenge aspect of it. The major challenges in terms of data are in terms of quality, comparability, and consistency on climate-related information. So the way we think at the fund, it's in terms of like a climate information architecture that is composed of 3 blocks. One has to do with high quality, robust, reliable, comparable data. That's block number 1. The second block has to do with having an harmonized set of disclosure standards. So think about like some minimal standard in terms of sustainability disclosure. And then the third block is in terms of taxonomy. So taxonomy is essentially how to communicate, having some sort of common language. And so potentially down the road, get to a sort of minimally agreed upon global taxonomy. In terms of data, which is the point number 1, I think there are a number of challenges related to data. Again, to availability of data, reliability, and consistency, right? So one is lack of granular data, verifiable data, and forward-looking. Right? When we think about transition, for example, the forward-looking is the part that it's more the most challenging, whether this is about metrics, whether this is about targets, particularly on the sustainability, on the transition to a sustainable business model. The second part of the gap, this gap is particularly relevant for SMEs, for small firms, for example, as they need to report data and collect data, as well as for firms in emerging markets, where there are a number of challenges, particularly on the transition side. There are also high costs in terms of disclosure, third-party verification, and also sometimes there's a feel of like lack of clarity on what you've been asking to those that need to report. And when we think about information here, essentially it's like a data chain, right? It starts with like what we could call the borrowers, whether those are corporates or whether those are households that take out a mortgage, for example. The second step of the chain information is lenders, right? Whether those are financial institutions, like regulated financial institutions like banks, or whether those are non-bank financial institutions. And then we have investors. And so clarity on who needs data for what purpose and what would be helpful to disclosure. I think it's something that it's the way we have built essentially the NGFS report, very user-centric case study on like who needs data for what. And then there's this sort of verification and auditability of data and how to avoid risk of greenwashing. So this is the data piece. And then step number 2, it's about the set of disclosure stuff. And I think the problem here that compared to financial disclosure, we have the sustainability disclosure is still sort of like in its infancy. It's much younger than what we think about in terms of financial reporting. And it's a very fragmented space, right? With a lot of number of frameworks out there that, for example, corporates have been requested to report to. Now, TCFD is the one that has been, it's under the umbrella of the FSB. It's probably the one that is more advanced on the field. But even there, the reporting under the TCFD recommendation, while has improved, remain much lower, for example, again, for SMEs, because the cost of reporting there are much higher. Then there is the issue of the taxonomy, which is the one that is probably the least developed part of this. And so there's a need for a global taxonomy, again, speaking the same language globally, at least some minimum taxonomy. There are a number of taxonomies out there. I think if you look at both private and public sector, it's like north of 200. Some of them are the public sector. The more known probably are the European Commission one, the Chinese, there are some other in Asia. But there's also a plethora of taxonomies that is being used in the private sector. So the point is to avoid fragmentation, both from a regulatory landscape, but also from a market standpoint, right? Those are global markets.
You went on mute. Sorry.
How do we bridge this gap? In terms of data, I already mentioned the work at the NGFS, and we are producing an interim report that should come out in the month soon, in the month of May, probably. And again, very user-centric, thinking case studies for those who are the needs of data. And so what is available? What are the needs? What is available? Where the gaps are? And how do we close this gap? And disclosure is one way to close this gap. There are also other ways to close the gap. Technical solution is an answer, for example, artificial intelligence, open source in terms of both collecting data as well as software that can be used, and also developing proper information systems. Now, you mentioned the IMF climate change dashboard. That aims essentially at the needs in terms of macroeconomic and financial data. And it's a dashboard that is publicly available and that's been launched by the fund during the spring meetings. On the standards, I think the fund support the IFRS Foundation effort to come up with global sustainable standards. This is in conjunction with OIOSCO, a number of other stakeholders, including the 5 alliances that put together a prototype. So there is a good way of starting. There is an acceleration of effort there as we move toward COP26. So I think there is momentum building there on the standard. But again, standards by themselves are not alone if you don't have some consistency and comparability on the data. So I like to compare usually the standards to like a bookshelf, right? We can all have the same bookshelf, but you gotta have an agreement on what the books that you're gonna put in the bookshelf. Those are the data essentially. And then there's the third piece, the taxonomy, as I mentioned. That's where we have seen less progress. And more progress needs to be done there to avoid that we have 200 and more taxonomy around the world. Now, that was on the climate information architecture question part. The second question was in terms of the GFSR and what we do in terms of growth and risk. So we have features climate in a number of issues in the Global Financial Stability Report. We started in October 2019, looking at the ESG markets. We covered like whether physical risk was properly priced in global equity markets last year. And we plan to do a chapter coming in for the October, looking at transition risk in the asset management. So there's a number of work that is being done there. The most challenging part is how you incorporate this consideration into growth and risk, right? So growth and risk, for those who are not familiar, it's a way of thinking instead of like providing essentially a forecast for the mode forecast or the baseline, which is what the World Economic Outlook does. We look at the entire distribution of GDP outcome. And so given essentially current economic and financial conditions and based on historical relationship, it projects out the distribution of GDP. And then we look at the left tail as the downside risk, the financial stability, the 55th percentile. Now, the challenges here refer to one, to the time horizon, right? So growth and risk usually is 1 year ahead. This is what we call short term, or 5 or 3 years ahead, which is what we call medium term. In transition, especially the transitions are, we're talking about 20 years, 10 years. So the timing would have to be adjusted. There are issues with shocks. Usually we look at financial or real shocks. This is a very different shock, or the climate shock. So how to incorporate those. Whether the financial condition index we use are appropriate to do this, right? Those are constellation of asset prices built around traditional asset prices. So interest rate, equities, and if those financial conditions do not capture essentially climate risk properly, then the entire exercise is not going to work because it's not going to provide any information on the distribution of the shape of distribution. The last point is about vulnerabilities, right? So the idea is to have essentially a shock. It hits financial condition, it's filtered and amplified by vulnerability. That's how you get this distribution of GDP. How do we think in terms of vulnerability? I think physical risk, it's easier to think of vulnerability, especially if you do project the distribution over the next 1 or 3 years. When you think of transition risk and what the vulnerability that should fit into the amplifier system, I think it gets much more difficult because it relates back to the data. You have the data essentially to have this like matrix of vulnerability as an amplifier. Then finally, I'm going to stop here on the EPSAP very briefly. The EPSAP has already looked in the past to some climate risk, right? So we've done a bunch of EPSAP on, for example, Caribbean island, and it was primarily focused on physical risk, right? So whether those are major climate events. We've done for the more advanced or systemically important financial systems, the EPSAP a look at particularly at the insurance sector, right? So the resilience of the insurance sector to some of the shock. We have done two more climate-focused EPSAP, one on physical risk and one on transition risk in Norway, in currently actually, that has been published. I think going forward, the EPSAP strategy is going to focus on 3-pronged, one having like a diagnostic, like what are the climate risks essentially you want to focus. How to think about climate design in terms of climate scenarios, and it leads back to Kevin's point, and how to embed those into the macroeconomic forecast. And the idea is to have 2 different horizons, one at the 3-5 years and one at the 30-50 years. So more longer term in terms of like a supervisor thinking about. And they face the same challenges in terms of uncertainty about modeling, uncertainty about policy, and ultimately uncertainty about data. So just to close on the data side.
Thanks, Fabio. So Alex, there's a lot of discussion about whether banks and insurers and other financial institutions, and for that matter, non-financial companies, should disclose climate-related risks. And I wonder, having been involved in both traditional stress testing and the 2021 biennial exploratory scenario at the bank, how do you see disclosure and analytics evolving to complement each other? and perhaps
Oh,
You're muted, Nick.
You're muted.
hitting the wrong button. And so what actions, if any, do you think the bank and other authorities may take or should take now that you're out in response?
Okay, thanks. Great questions, and thanks for having me on this panel. It's always good to go last because you get to respond as well to what others have said. And just before I answer your questions, Dick, I do want to agree with Kevin on the point that this isn't really a stress test per se, but actually I'd take it a step further, which is I think the key difference is that this fundamentally isn't about tail risk events. It's not about, Fabio was describing the growth at risk methodology. You know, it's not about saying what's the 1% probability event and let's try and build resilience to it. Actually, this is about assessing how risks in banks and insurers' exposures will evolve over time, given things that we just know will happen. We know the temperature has risen and we know it will rise further. We know that will result in more frequent extreme weather events. We know that many governments, including the UK government, are committed to net zero carbon emissions in the economy by 2050 or sooner. And so we know that there's a policy response that's inevitable to deliver that. So fundamentally, this is about encouraging financial institutions to look ahead and factor those known trends into their risk assessment. But as Kevin says, where it differs is in its horizon. It's long-term nature, it's looking ahead. The Bank of England exercise that you cited will look ahead with a 30-year scenario. But actually, I think the time is coming where, you know, the term of banks' exposures, the loan terms, will now include soon a period in which the effective carbon price, the shadow carbon price, is a lot higher than it is today. So failure to take that into account before too long will actually mean loans being mispriced and capital being misallocated. And we're not far off that point at all. We may already be at it. You look at the NGFS scenarios. Fabio introduced the NGFS. You know, the scenario that limits the temperature rise to 1.5 degrees and delivers net zero by 2050 has the shadow carbon price going to well north of $100 a ton within a decade. So it's important that banks' lending decisions very soon and insurers' decisions very soon actually start to take full account of these risks. Otherwise, we'll get these problems of capital misallocation. And to be fair to banks, they really are leaning in to this. We saw only last week the establishment of the Alliance for Net Zero. 43 banks, 30 trillion of assets on their balance sheets, committing to align their portfolios to the transition to net zero and to disclose their plans. So, you know, I can't put it better than Secretary Yellen actually the other week, who said, the thinking goes that because we know so little about climate risk, let's be tentative in our actions or do nothing at all. This is completely wrong in my view. This is a major problem and it needs to be tackled now. I think she sort of hit the nail on the head there. The challenge though is that the data, the analytics, the disclosures, as we've heard from Fabio, they're not perfect today. But I would say actually that this is a bit chicken and egg. And the right thing to do is to go ahead with these exercises, because actually they will spur the generation of data. They will spur the development of the analytics. And so you've got to start somewhere. And this, I think, is where to start. I think waiting for the perfect data and the perfect analytics before we do it will just mean we've completely missed the boat and financial institutions are failing to factor these known risks into lending decisions as it increasingly matters. So how might disclosure and analytics evolve? I think, firstly, to go to Fabio's point about the sort of climate information architecture and the data chain starting with the borrowers, I think the first thing it will do is spur the creation of data from the non-financial sector, so the counterparts of banks. It'll spur the creation, as Fabio put it, of comparable and harmonized data, I think. And the reason for that is that banks, as a result of needing to do these exercises, are going out and haranguing their counterparties for information in order to complete the exercise. So we know that, for example, the Bank of England exercise that's about to launch, banks have to submit very, very detailed analysis of at least their top 100 corporate counterparties. And that means having detailed analysis of those counterparties' mitigation and adaptation plans. And you might be able to get those from a TCFD consistent disclosure, but as Fabio said, particularly for smaller companies, you probably won't as it stands. But actually the act of your bank needing this information in order to perform the risk assessment is actually the spur for the counterparties to produce the data. And I think, therefore, that doing these exercises will be a spur for further progress on the TCFD front, and in particular, as Fabio put it, the creation of harmonized data, because effectively what banks are asking for across their counterparties is not just what are your scope 1 to 3 carbon emissions today, but what's your corporate plan and what will they be in the future? Because the bank is trying to assess credit metrics looking ahead based on a different carbon price to the one that's prevailing today. So I think that's the first thing it will spur. Second thing it will spur is disclosures by banks themselves. And I think that's probably the next step after these exercises. Actually doing this analysis is the necessary condition for that. Banks themselves will want to become TCFD compliant. Banks have obligations under the Basel requirements to disclose material risks. And before too long, as I say, these will be really material risks in existing exposures. So part of this exercise is about building the capability, building the muscle to make the necessary disclosures as the risks become more material. And I'm pretty confident that investors will demand these disclosures too. The cost of capital for a bank, where there's massive uncertainty about its exposure to transition risk, is going to be higher than it is for another bank that's done a serious analysis and disclosed it. So I expect to see bank disclosures develop. That's why banks are building the capability. And it's no surprise that banks are therefore lining up to do this. The Net Zero Banking Alliance, as I say, launched last week, banks are committing themselves to align their portfolios to the transition to net zero and to disclose their decarbonisation plans on a sectoral basis. So those are two kind of disclosure developments, I think. I think the analytics development is really interesting. And I don't underestimate the existing state of analytics and data, actually. So I think we're going to see first physical risk assessments develop. That's going to require more spatial analysis of exposures. The ECB exercise recently looked at top-down physical risks of corporates by their location in the euro area, using sort of physical risk scores by very micro location, and using that to reassess PD, or probability of default, accounting for rising temperatures and more frequent extreme weather events. I think we'll see the development of those sorts of analytics. And the other analytics I think we'll see developed is the ability to assess traditional credit metrics as the effective carbon price rises. I think, as John Hale said in the last panel, actually, this is a bit like equity analysis, taking account of a wide range of information to produce new estimates of probability of default, leverage, earnings, all those kind of classic financial metrics. And we're increasingly seeing people being able to map what's fundamentally a carbon price scenario, although that carbon price can capture, it's a summary statistic for a whole range of actions. Capturing those things into a PD is effectively what this is going to all be about, at least for banks. And it is happening. And people are doing it. And as Hyun's analysis at the beginning of this session showed, you can do increasingly sophisticated financial type analysis as a cross-check on this as well. So I'd expect to see the development of what fundamentally what Hyun called carbon betas for everybody, but not just based on their current emissions, based on their detailed mitigation and adaptation plans as well. And then finally, what actions on the back of it? Well, partly this isn't something that needs action on the back of it. The big prize here is building the capability to do the risk assessment for the future, so that loans and insurance policies can be appropriately priced and capital not misallocated. What else do you want? Some people say, it should be a sort of gotcha stress test, and you find that banks have got lots of carbon exposures and you whack a capital requirement on it. Kevin was describing much more eloquently than me, a sort of traditional stress test. Actually, this isn't what this is about, because right now, given typical loan maturities, the risk isn't hugely mispriced or mismeasured. But as time goes by, and pretty soon, if you fail to take these things into account, it will be, the carbon price will rise, risk assessments will need to shift, and banks will need over time to capture that in their risk models and hence their capital requirements. It's not, radical to say that as the risk on an exposure changes, the risk weight and hence the capital should change. We're now in the period though, where that's not yet needed, but banks can anticipate it and make their lending decisions on the basis that maybe an exposure will look riskier before the exposure matures, and capital requirements on it will go up in the future. But that's down the road. Right now, this is about building the capability and being able to anticipate those things, so you can sort of telescope them back to the present and make decisions today on that basis, rather than waiting for all these developments to happen and then having a sort of disorderly, sudden reaction. So in case you missed my messages, we got to lean into this and get on with it. Thanks.
Thanks so much, Alex, Fabio, and Kevin. So I think we've heard some really great distinctions being made today, starting in our disclosure panel between where John Hale talked about the distinction between data and disclosure. And that's a very useful distinction that's come out in this discussion. Second, a huge distinction between scenario analysis and stress testing, which have different goals, different technologies, different methodologies, and different muscle, to use Alex's term. Third, I think a difference in time horizon, which is extremely important when we think about this and relates to the second one. And that clearly means that we have to connect those two things over time. Because if we think about, the short time horizon that's traditionally used for stress testing, then the question is, how does that connect to our much longer time horizon for, for scenario analysis? And I'm, thinking about Alex, your former boss's seminal talk on the tragedy of the horizon. We don't want to get too caught up in the idea that there's a virtue in sort of a programming sense that will automatically translate that long horizon back into things that we need to do today. Those are all important questions. Alex, you mentioned insurance companies, and there was a question in the chat about insurance companies. And for everybody, it's pretty clear these folks are writing options on the probability of certain events, taking place, whether they are primarily physical risk, which they insure against, but longer term against transition risk, which they may or may not take into account in making the decisions. So you guys typically focus on risk in banks. What about insurance companies, the broader financial system, and the feedback to the economy? And I guess, Alex, I'll start with you since you brought up the insurance issue.
Yeah, okay, thanks, Nick. I'd just say that the Bank of England exercise that's about to launch is of banks and insurance companies. So that you can have common scenarios, you can look at some of the links between the two. As you say, for insurance companies, it's more about physical risk, at least initially, than about transition risk, but not solely. And I would say that actually insurance companies, or many insurance companies, have actually been at the cutting edge of these analytics, because it is the nature of their business. When you're insuring against extreme weather events, you're pretty cutting edge about your analysis of the likelihood of those events. So some of this is about regulators keeping up with the industry as much as it is about forcing the pace of the industry. But I think it's important to include insurers predominantly for that reason, but also, as you say, some of their risk will be on the transition too. In terms of the broader financial system, I think start with banks and insurers, because they're the ones sort of taking the risk on their own balance sheet. I think it doesn't necessarily make sense to stress test a financial institution where the investment risk isn't actually with the financial institution, it's with end investors. Those are issues more about disclosure, measurement, and such like. I think, though, right now the focus is on banks and insurers, because they're the ones to whom resilience to these risks is really needed in order to ensure the continued supply of credit at the right price to the right people through the transition. To take the limiting case, if we have a banking system that isn't resilient to transition to net zero, it's an obstacle to transition to net zero. And from a societal perspective, given government's commitments, it's not ideal at all. I think, so start with the really core bits of the financial system and maybe over time broaden out, but I would anticipate doing it in a slightly different way with other institutions.
Thanks. And Fabio, you alluded to this in talking about the GFSR and growth at risk and related issues. Any thoughts about the connection there?
I think that in terms of like the priorities, right, which institution you focus on, in some jurisdiction, I'm just picking the US for a second, right? If you think about credit markets, in some segment, banks are essentially not the majority. They don't provide the big bulk of like credit. It's in the non-bank financial institutions segment, right? And that includes a variety of institutions. So it could be insurance companies, but pension funds, hedge funds, structured finance. And so if you want to think about from a systemic point, I think the question then how you get after those, right? Because the banks could get out of the business entirely, say, as an extreme. But credit could migrate through the NBFI sector. And if you take out insurance for some of this, I'm not even sure if you think about who has the mandate to think about financial stability risk. Even if you agree that this is a financial stability risk, if things migrate away through the NBFI, I'm not sure who the supervisor are for some of these entities, whether there is anyone with a federal mandate in the US, whether they have a financial stability mandate to do that, and what kind of tool they will employ. So there is that aspect there in terms of allocation of credit. Maybe this is more specific to the US than other jurisdiction, but the NBFI sector, it's a huge component of credit provision in the US. Then who do the stress testing there? Based on what data? There's not even data often, not even to assess exposure to more mundane kind of credit risk, right? The second aspect, perhaps, it's then if you go to emerging markets, I think there's an issue here, which is the transition risk. It's a much bigger field there, perhaps, than in economies. And so when we think about standards or taxonomy, how to account for, how to incentivize the transition from brown to green, right? The vast majority there is greenish, brownish. So how to set up a taxonomy that actually provide credit and incentivize the transition there. Otherwise, we're asking some of these emerging market countries to essentially accelerate the process from industrial revolution where the advanced economies has taken like decades to get there. And so how to set up a system that, yes, it's standard across the globe that can measure this risk, but in a way also that it brings this country in a way that does not affect in adverse way their growth pattern, right? I think that's an important point to keep in mind here.
Great. Rather than go immediately to Kevin, I've got two great questions from the audience. First, from Till Scheuerman. As you all pointed out, the typical stress test today is on a much shorter time scale, 2 to 5 years typically, with relatively sudden moves in risk factors than climate timescales presumed, or we presume to have them move. It's a little harder to take countermeasures against fast-moving risks. So in that context, how should we think about climate shocks? Is it a sudden and massive repricing of assets, a sudden belief updating, or a sudden very disruptive policy change like the introduction of a big carbon tax that changes transition risk thinking? Kevin, I'll start with you.
So I think it's probably all of the above. And when you think about the types of transition risks that firms may face, there are certainly longer term risks as, say, technology evolves, but there are also shorter term shocks that could be a dramatic updating of investor beliefs, consumer preferences, a policy change that impacts the price of carbon in the very short term. And part of the analytical work that we've seen the financial industry doing is the kind of sensitivity analysis to those different scenarios. What would be the impact on a balance sheet or a set of exposures of a large change in the price of carbon over different time horizons, for example, and trying to understand whether our current business model is robust and resilient to that range of potential outcomes. Again, it's not necessarily saying you must do X or you must do Y, but asking the question of how would your business evolve if one of these shocks were to materialize. And maybe just one other point linked back to the last conversation. I think these second order effects that Fabio mentioned are really important That's something that we heard a lot about in our Basel Task Force report. You know, firms and consumers respond, the economy adapts. Things that people think are mitigants today might not be mitigants in the future as financial markets adjust. And I think that's an important part of the economy-wide, the financial system-wide scenario analysis work, asking whether the different components are internally consistent. And assumptions from one sector as a mitigant might be something that they may or may not provide in the future. And whether it's insurance markets or securitization or derivatives markets, all of this will evolve in ways that are very challenging to model. But that's part of the evolution that Alex spoke about.
Absolutely. Couldn't agree more. And one of the things we may see that you just alluded to is the idea that insurers may raise their premiums on certain kinds of activities, which will work towards moving capital in the right direction. We have a question from Jay Bruns, who's in the Washington State Insurance Commissioner's Office, and we're going to hear from his boss in a few minutes. Have any of the speakers' institutions used the results of the NAIC, National Association of Insurance Commissioners, Climate Risk Disclosure Survey in their analysis? This is a required annual survey capturing about 460 of the largest insurers operating in the US, and they're publicly available on the California Insurance Department website. Any thoughts about that? Sounds like a useful source of information.
I have not used them.
Okay. All right, well, we're just about at time. This has been a fantastic panel. There are more questions than we have time to answer here, but thank you all for participating.